Today's extended trading idea focuses on gold miners via the VanEck Vectors Gold Miners ETF, GDX ticker. Now, gold miners sit at the crossroads of several long-term macro themes. Global monetary easing cycles beginning, inflation protection, declining real yields, and rising geopolitical uncertainty. Now, the key question for investors now is whether gold miners are simply reacting to short-term moves in gold, or whether seasonality and macro conditions are aligning for a structurally stronger phase ahead. Now, the chart on the screen here shows the seasonal trend of GDX over the last 20 years, and the pattern is very clear. Gold miners tend to perform best early in the year, with strength building from late December into the first quarter and extending into spring. Now, using the Seasonax window from December the 23rd through to April the 11th, the statistics are compelling. There is a roughly 79% winning trade percentage. Average return is 10.13% over the last 20 years, and the total profit is 48 points. And there's a strong cumulative profit curve over 2 decades that's picked up in particular over the last 4 or 5 years. So this tells us that gold miners historically respond very well to early year positioning rather than late year momentum chasing. So looking at the chart, the seasonal structure, what's the chart telling us? Well, it's telling us that strength accelerates into Q1 and weakness typically emerges later in the year, especially into autumn. In other words, gold miners are not a classic Q4 trade. They're an early cycle seasonal asset. So if we compare gold miners to gold, the pattern and the relationship does become even more interesting. Gold itself often firms up early in the year, but gold miners magnify that move due to operational leverage. There's margin expansion when gold prices rise and capital flows into higher beta precious metals exposure. So historically, when gold stabilizes or maybe trends modestly higher, miners tend to outperform on a relative basis. You can see gold's average return is 4.40% versus GDX miners with an average return of 10.13%. Now, if you contrast this with the broader equity market, many equity sectors, particularly cyclicals and growth stocks, tend to find their strongest seasonal tailwinds later in the year, often in the fourth quarter. And you can see the S&P 500 tends to enjoy a strong fourth quarter. Look at that seasonal pattern. It's a very strong 83% winning trade percentage and a 4.89% average return over the last 20 years for the S&P 500. Gold miners, they're different. And their strongest seasonal performance comes before that traditional equity rally. And it aligns more closely with falling real yields, rising rate cut expectations, with the Fed expected to cut interest rates at least a couple of times next year, and defensive or diversification flows. So this does make gold miners a potential early cycle hedge rather than a late cycle trade. Now, from a macro perspective, the environment increasingly supports this seasonal setup. We're seeing rate cut expectations being pushed forward. The last CPI print from the US was below market's minimum expectations, although there are some processing issues due to the way the Bureau for Labour Statistics calculated that last data. We've got ongoing central bank gold accumulation and persistent geopolitical risk. And at the same time, mining equities remain structurally under-owned after years of sort of capital discipline and general investor skepticism. So this does potentially create asymmetry. Gold doesn't need to explode higher for miners to work. Even stability in gold prices has historically been enough to drive out performance during this seasonal window. Risk considerations. Of course, there are risks, and just because you've got a strong seasonal pattern doesn't guarantee that it will happen every year. Gold miners are still very sensitive to sharp US dollar rallies. Not everyone thinks that the dollar is going to be in a downtrend for next year, for instance. Equity market drawdowns, if markets are really worried, they can sell everything, and that includes gold miners and gold. Cost inflation pressures also can impact this outlook. But seasonally, right, this early year period has historically been when those risks are most effectively absorbed. So to summarize, GDX shows a statistically robust early year seasonal pattern. The strongest performance does come before traditional equity strength. Macro conditions continue to support precious metals, and gold miners offer a leveraged exposure without requiring a gold breakout necessarily. So the open question remains, are gold miners about to re-emerge as a core early cycle hedge, or will macro volatility once again delay the momentum? So while no one can predict the future, obviously, we can use an extensive database combining seasonality, macro context, and market structure, and that helps investors to make better informed decisions in turbulent capital markets. And if you look at the maximum loss, you see the maximum loss is 23.79%, and the maximum drop has been 31.58% here in 2019, even though it ended up being profitable for the pattern at 10.84%. So there are some quite hefty potential drawdowns. So if we just look at the GDX chart, we can see we're in a clear uptrend. On the weekly chart, we can see we're trying to break above this recent swing high. Price breaks, closes above, pulls back, support. We're trying to move higher. Looking at the daily chart, you can see that we're in a clear uptrend, high highs, high lows, high highs, high lows. Price staying above the 50, 100, 200 exponential moving average. So if we look at the drop, if we saw a drop here, right, that would be a fall of 9%. So that is in keeping with some of the drops we've seen in previous years. Where is it? Yeah, you can see some of the drops we've seen in previous years. That even when it's been positive, we've seen a drop of 8%, 14%, 11%, 10% still positive year, 13% negative, 18% still positive. So that means it's not unreasonable, right? If we did see a pullback into that area, and investors could look for price action signals, maybe a support at that 77 region, anything like that could be a reasonable area to buy.